There's a very popular claim right now that says we do not need the Federal Reserve. We don't need any central bank, and that the free market could do all of this better. Things like this. Um, I think that argument is intuitive, very principled, grounded, and it's really appealing to a lot of people. But I think it misunderstands how the modern monetary system actually works. So, in this episode, we're going to mechanically answer or try to answer one question, and that is, do we actually need the Federal Reserve? Not whether we like it, not whether it's perfect, but whether removing it would make things better or worse. So the myth goes a little something like this, okay? That the Federal Reserve does two things. It sets interest rates and it regulates banks. And both of those things, the argument goes, could be handled better by the free market. If interest rates were allowed to float freely, they would naturally find the correct price. And if banks weren't protected by bailouts, they would self-discipline and manage risk properly. So we don't need to replace the Fed. We just need to get rid of it. And that's the claim. Okay, so let's talk about part one, okay, and why this is not correct, okay? Interest rates. Let's start there. Okay, so yes, in isolation, interest rates are prices. And yes, prices do convey important information. But I think here's the key mistake. The federal funds rate is not the price of credit in the economy. It is the price of settlement liquidity inside the banking system. The Fed does not set mortgage rates. It does not set corporate bond yields. It does not set credit card rates. Those rates are set by markets. What the Fed controls is the rate at which banks settle balances with each other overnight. That matters because modern banks do not operate with physical cash. They operate on balance sheets, and balance sheets they must settle. So without a central settlement anchor, interbank markets don't clear smoothly. They fragment, they seize, or they overshoot violently. And we have historical proof of this, okay? In the late 1800s and early 1900s, before the Fed existed, the U.S. experienced repeated banking panics. And this wasn't because markets were irrational, but because there was no elastic settlement layer. Interest rates didn't float freely. They spiked uncontrollably during stress. Liquidity disappeared exactly when it was needed the most. So I think the idea that removing the Fed would give us cleaner price discovery ignores the reality that settlement really at the end of the day is not optional. Someone has to supply it when markets can't. So part two, the free market can handle liquidity. Okay, this leads us to the next claim. That the free market could handle liquidity provision better than the Fed. But here's the problem. Liquidity is not profitable to supply during a crisis. When everyone wants cash at the same time, no private actor wants to be the one lending it, because doing so risks insolvency in a lot of ways. That's why central banking exists in the first place, I think. Not to control the economy, but to act as dealer of last resort when markets are frozen. Without that function, small liquidity problems turn into, solvency crises. And that's not theory. This is what happened repeatedly before central banks existed. So part three of this, let's talk about bank regulation. Okay, the argument says if banks weren't regulated and weren't bailed out, they would manage risk responsibly. And in theory, it's very reasonable sounding. But in practice, I think it fails for one simple reason. Okay, depositors cannot monitor bank balance sheets in real time. Banking is built on maturity transformation. Short-term deposits fund long-term assets. That structure is, I think, inherently kind of fragile. So without oversight and backstops, banks don't self-discipline. They race to expand during booms and collapse simultaneously during stress. That's why every advanced economy, regardless of ideology, ends up with some form of central banking. And it's not because governments love control. Those are different conversations, but because unregulated banking systems repeatedly collapse. I want to make an important distinction here about independence. So let's be very, very clear about something important. The Federal Reserve is not independent in the way people think. It is created by Congress. Okay, its mandate is set by Congress. It exists to serve the government's monetary framework, but that is different from being controlled by the executive branch. That distinction is so important, I think, because when central banks lose operational independence, history shows us what happens. Interest rates are suppressed for political reasons, okay? Debt is monetized more aggressively. Inflation accelerates, and currency credibility, forget about it, it erodes. We've seen this pattern repeatedly from post-war yield curve control to emerging market crises to modern fiscal dominance. So the core reality, I guess, here, maybe the uncomfortable truth, the Federal Reserve has caused distortions. It has contributed to asset inflation. It has increased inequality. It has protected the financial system, at the expense of households. All of that is true, but abolishing it does not remove those problems. It removes the shock absorber. And without that shock absorber, I think the same system becomes far more unstable, not freer. So the myth is not that the Federal Reserve is perfect. The myth is that removing it would give us a clean, self-correcting free market. And that world does not exist in a global, leveraged, balance sheet-based financial system. The real debate is not Fed or no Fed. The real debate, I think, is what constraints, rules, and limits should exist around monetary power. And that's a much harder and I think a much more honest conversation. If you want or enjoy more breakdowns like this, focused on structure, keeping ideology out of the picture, this is what we try to do here at the Global Ledger. So once again, I'm Justin, and thanks for watching.